Let's talk about Bank of America, 0 down payment, 0 closing costs for Black and Hispanic homeowners. All right, I got a lot to say about this subject. It's good in some ways and it's terribly horrible in some ways. There's a lot of risk involved. What a lot of people are afraid of is it being a repeat of 2008. 2008 stems all the way back till late 80s, early 90s when Bill Clinton signed in I forget what the act was called, but basically where subprime mortgages were allowed in order to allow low-income families to purchase a property. Now, don't take all of these words that I'm using as these terms are technical terms. I'm not the most technical person. A lot of people think that this thing that Bank of America is doing is a answer to the housing crisis or the looming housing crisis that everybody keeps talking about, which there's not really a housing crisis. There's just basically a lot of high-priced houses and there's not enough. And the only reason that the prices of the houses are so high is because there's not a lot of houses on the market. We as a country have gotten into this situation with the housing market. What Bank of America is doing is not an answer to this. What Bank of America, what their intent behind this was Joe Biden trying to fix the disparity between loans being given to white homeowners compared to Black and Hispanic homeowners, because they say 72% of white homeowners are okay for a loan. When it comes to Black and Hispanic, Hispanic was like at 51% and Black was at like 43%, the lowest. What they have done is Biden came in and he set up for that to be equal and for more Black people to get approved for loans. So what they did is basically they did this research and they found out that the main reason that most Black and Hispanic homeowners can't get qualified for the loan was the amount of down payment, and that the down payment couldn't be met. So they came up with this 0 down payment to answer that. Now that we know why and the reason that Bank of America came up with this, let's look at the effects of this, okay? So true enough, what happened in 2011 was that a lot of people, in 2008, which started a long time ago, all these subprime loans, what happens is when you pull out a loan, your interest rate, meaning the amount of interest that you pay on top of the principal and your payments, is set at a certain number, at a certain percentage. But if that interest rate was to go up, then your monthly payment would drastically go up. What Bank of America is doing this time that makes it different from the last time is these loans are fixed rate loans, and they're only doing it in a couple of cities nationwide. I think they were, I don't have them in front of me, but I think they were Los Angeles was one, Charlotte was one, I think somewhere in Louisiana, Dallas was one. There's a few of the bigger cities that they're gonna try it in, I guess because they're more populated. Another way that they made this different than last time is last time you didn't really have to be qualified to be able to purchase the property. You just basically, anybody could get it. Now that you have to meet certain requirements. So you don't have to have good credit, but what they're saying is just because someone doesn't have good credit, that's not the only way that they can be able to tell that somebody would be able to make their house payments, because a lot of people have taken on credit of things that they couldn't pay for, but they always paid their rent. So what they're looking at outside of their credit, so they're not looking at your credit, they're looking at your rent history and your utility bills. How well are you paying those bills? That's what they're looking at. Of course, there is risk to it, and in my opinion, that risk is tied to ownership and value in lower income neighborhoods. What I mean by that is the only way that banks can get ownership in any kind of property is by foreclosure. So basically financing a loan for someone, and then when their property is been foreclosed on, at that point then the bank can take ownership of the property. In my opinion, a lot of these type of loans are formulated in order to cycle a lot of the properties back into the hands of banks. So they don't mind taking the risk, because in the long run, if you can't pay it, the bank will end up owning the property, and at the rate that values and properties are going up right now, I don't think anyone has a problem with owning a property as far as a bank is concerned. So the bank can't really lose with making these types of loans. The long-term effects of this is gonna be the people that can't afford them, they'll be foreclosed on, and the people that can, they will have gotten a great deal into getting into their first property. This is coming at a great time for banks, because right now banks aren't seeing that the interest rates are going up, and they're still going up because people aren't moving forward to buying a house. A lot of banks aren't selling houses, so we're at a point where this comes in perfect timing for where if they do this trial and it works, the banks will be able to move mortgages again, because the main problem that people are having right now with moving is the interest rates and being able to pay to get in. So if they could get you to get in because you can't really afford the down payment, then you'll get into a loan, even though the interest rates and even though everything else about the loan may not be in your favor, they know they'll get a significant amount of people to actually go and get it. Another thing that I really don't like about it is that I believe, and it's not so clear about it, you basically gotta buy in the hood, a cheap house that's in the hood that could possibly in the next few months or so, if the housing market does take a dump and prices do go down, at that point you will be owning a home and you'll be underwater. What I mean by underwater, if you don't know, underwater means that you owe more on your house than your house is worth. So it's something to look into, it's something to look at, it's something to look into if you're thinking about doing it. I'm not saying getting this loan is a totally bad thing if you could afford it, but if you can't afford it, it's not gonna be a good thing, because what you're essentially gonna be doing is playing a part in your own downfall. So just because it looks like an easy deal to get into and it looks like something to do because you think home ownership is the holy grail and like you feel like you gotta own a home, you should do it when the time is right and when you can afford to do it, when you can afford to maintain a home. If your roof caves in, if your AC goes out, you have to be able to have those funds on hand in order to take care of that home and to keep that home up to date. So it's just something to think about. If you ain't subscribed to the channel, if you like this content, go on and like it, hit that thumbs up. If you haven't subscribed, go on and subscribe to the channel so you can see more videos about real estate, about finance, about hustling, about whatever. Go on and hit that subscribe button, hit the bell notification so you're notified when I drop more videos. But until next time,